G'day there, Ray Corcoran here. In this week's video, we're going to be talking about ETFs. What are they? Why does everyone keep recommending them? How do they fit into your overall portfolio? And how do you get started investing in them? So there's been a lot of personal finance gurus that always bang on about investing in index funds, investing in ETFs. But if you don't know what they are, you're kind of left scratching your head, wondering, how do I get started? Can I learn more about them? So that's the purpose of this video. I'm going to explain the basics and the fundamentals of what they are, and what they can do for you, more importantly. And as always, if you like the video, give it a like. Liking the video helps it push it out to a bunch of other people, new people with the YouTube, their amazing algorithm. So I really appreciate that. Also, if you want to subscribe, please consider subscribing. I do weekly videos on making money, investing money, and saving money through my favorite topics. So if you're interested in that sort of stuff, please consider subscribing. So what are ETFs? So ETF stands for Exchange Traded Fund. So that means it's traded on the stock exchange. ETFs are kind of like, if you invest in individual stocks, it can be quite high risk. If that company goes well, you're really happy. If it goes down, you can lose a lot of money quite fast. Now, ETFs are kind of like buying, instead of one stock, you buy a bundle of stocks. And that bundle could be, for example, the top 100 companies in Australia or the top 500 companies in America. And they have all these different combos, if you will, and groups of companies that you can invest in. So if you were looking to get the exposure to the top 500 companies in America, the S&P 500, for example, buying each one of those stocks would cost you thousands and thousands of dollars. But what ETFs allow you to do is you could pay $50 or $100 or whatever it is, and you can get exposure to a whole bunch of companies depending on what type of ETF you've bought. And the result of that is you get a lot less risk, because instead of putting all your eggs in one basket, you're kind of spreading your eggs across, it could be 30 companies, 50 companies, 100, 500 companies, and you're generally kind of making a bet on that sector or region. So you can have ETFs for emerging markets, a group of, a cluster of companies in emerging markets. You can also have ETFs for certain sectors, so tech or pharmaceuticals. There's ETFs around sustainable companies. So if you really want to invest and back and support sustainable companies, you can do that. So why do you buy ETFs? There's a whole bunch of benefits to buying them. So I've kind of already alluded to it, but the first one is you get less risk and diversification. So you get exposure to a bunch of companies rather than putting all your eggs in one basket. This makes it really good for someone that it's good for seasoned investors and beginner investors, but it's especially good for beginner investors because you don't need to be a stock picking genius to get some decent returns. You will probably get lower returns than if you pick an individual stock that goes crazy, but you get more certainty and reliability. There's always risk, but it's probably a little bit less risk because you're not just betting on one, you're betting on a group of companies, and they kind of can all average each other out. And if that bucket of companies all generally does well, you might make a 6, 7, 8, 9, 10% return each year. And obviously that fluctuates and it depends on what you pick, but you can get quite safe returns every single year. You might not get a 20 or 50% return from picking a stock that goes crazy. However, you can get quite a reliable 6, 7, 8, 9, 10% return. And for a beginner investor, I actually think that's a much better option, considering, if you don't know anything about buying stocks or valuing companies or assessing markets, it's an excellent option. That's why so many personal finance gurus always talk about investing in ETFs. The next benefit is the tax benefit. So it can be more tax efficient. Now, I'm not a financial advisor or CPA or accountant or anything like that, so you need to check for your individual situation, but what that will allow you to do is, often they'll find that because they're not, buying and selling stocks, individual companies all the time within that fund, you do have less, capital gains, taxable events and all that sort of stuff. But you don't really need to know that. Your accountant will help you sort that out. But I want to let you know that you can, that can be a bit more tax efficient as well. The next thing is the low entry point. So there's a low barrier to entry. You could invest in ETFs for a few $100s. You don't have to compare that to, say, a property. If you were to go to buy that property, you can pay tens of thousands of dollars in fees and stamp duty and all that sort of stuff to acquire that asset. With ETFs, you can get started at really low amounts, $100, $500, that sort of stuff. And it means that you can get your money working for you without having to save up a huge amount first. Another reason is performance. So there's actually a bunch of studies that have been done, and what they found was when they compared most ETFs are basically passively managed. So there's not someone, they're designed to track an index, maybe a top 100 companies in Australia, for example, and it just kind of mirrors that. So it doesn't take as much active effort from that fund to get whatever performance. It'll just follow what the market does. Now, if you compare that to a mutual fund, basically with a mutual fund, you know, they're trying to beat the market average, and they'll do lots of buying and selling, and they're trying to get the best outcome, and they're doing a lot more work to make that happen. Now, the catch of that is you can pay a lot in fees for people to do that. And what they found in a lot of studies is that the passively managed index funds and ETFs, they actually outperformed the more actively managed funds. And they found that even a small increase in fees can make a dramatic impact long term in terms of how much money you make off the back of that investment. And with some of these mutual funds, you know, the fees can be upwards of, you know, 0.5% and up, and then you can have ETFs that can be as low as, you know, 0.1% for some of them. So they all vary in terms of their fees, but the fees are a major factor to decide whether to go ahead with certain funds and ETFs. The thing I like about ETFs is I think they're really perfect for you to look at when you've paid off all your debt, starting with the most expensive, the highest interest rate debt, all the way down to the lowest, at least the bad debt. Then you've saved up your savings buffer of maybe 3, 6, 9, 12 months plus. You've got a bit of a cash buffer, your emergency fund. Then the next step most people make is starting to make some of your initial investments. Now, where do you start? If you don't know anything about stock trading, or you might not know much about property, you might not know much about business, ETFs are a really good option for you at this point. In terms of how do you pick, you know, which ETF to go with, you may look at some of the more popular ones that track the like Vanguard Australian shares, which I'll talk about in a sec. That tracks the ASX 300, the top 300 companies in Australia. That's by Vanguard. You may also look at, you know, funds that track the S&P 500, which is the top 500 companies in the States. But basically, there's a whole bunch of different ones you can look at. Some of the things that people use to assess whether it's a good fund to go with could be things like past performance, even though, you know, everyone says it may not be a good, reliable indicator of future performance, but they do look at that. They look at the reputation of the fund. So you've got people like, you know, Vanguard, who have a very good reputation for good performance and generally lower fees. And as I've said, the percentage of fees and what they call the expense ratio is crucial. We want that as low as possible. The performance to be as high as possible and the fees to be as low as possible. That will give us the best bang for our buck, essentially. The next thing people do to decide which ETF they would go with is also like what market they think is going to go up, or which market they feel like is poised for growth. So you might be personally very bullish on tech stocks, and you may look at a tech ETF which might have the top 100 tech companies all wrapped in an ETF. So that might be something that you invest in. You may be really particularly bullish on a certain region. You might think that, you might look at Asia, or you might look at emerging markets. You might look at Australia. You might look at the States. You might think a particular region may be ready, about to start performing really, really well, or it's already performing well and you think it's going to go even better. That might be a major reason as well. In terms of how to buy them, it's pretty straightforward. You can go to directly to someone like Vanguard. You can also go through a brokerage. In terms of brokerage sites, I'll put a bunch on the screen. There's a whole bunch of different ones. They all have different fees as well in terms of how much they charge you per trade. But basically, at a high level, what you do is you would go on their website, create an account, find the ticker symbol of that ETF. So it could be typically a three character code for that ETF. So say for Vanguard Australian shares, it's a VAS. You would type that in, say I want to buy some of that. You would type in either the dollar amount that you want to buy or the quantity of shares that you'd like to buy, and then you would place your order and you'd pay for it. And that's pretty much, at a simple level, that's pretty much how it works. In terms of the ETFs that I own, the first main one that I own is the global iShares Global 100 ETF by BlackRock. So basically that tracks the top 100 companies in the world. And I've got, I think it was, I'll put it on the screen, but I think it was about $22,000 in that. The second one is Vanguard Australian shares. So that particular one, I think it was from memory, about $100,000 that I've got in that particular one, and that tracks the top 300 companies in the ASX. And the third main one is the iShares MSCI Emerging Market ETF. So I think that's IEM from memory, and I've got about 42,000 roughly in that particular one. So by buying, and these all kind of perform at different paces, but I've got money in each of those, and that's all through Stockspot. I'll put a sort of a link to them below if you're in Australia. But basically, they kind of invest that for me. I kind of transfer money to them, and they kind of do the split and the portfolio rebalancing and a whole bunch of that sort of stuff. And that kind of gives me exposure to that. And I kind of make, several percent on that every single year. And the thing I love about it is I don't need to be an individual stock picking whiz to make those returns. For me, I'm focused on my business. That is 95% of my time. So when it comes to stuff like this, I don't want to spend hours and hours and hours learning about individual stocks. I literally have not got the time. Same for property. I get a buyer's agent to help me save time in terms of selecting property. I like trading, having my main focus, and everything else I like getting help for, or I don't mind paying a small fee to people to help me select certain investments. So I hope you found that useful. If you have any questions, let me know. If you're looking to buy something, let me know. Happy to sort of point in the right direction. Not financial advice, of course. But if you have any questions about this video or future videos that you'd like to see, please let me know. And other than that, I'll see you on the next video. Cheers.